Let's talk to Shaun Richards from NotAYesManEconomics. Shaun, welcome to the show. I wanted to talk to you about inflation, employment data, interest rates, and the car market in this segment. Numbers are coming through, employment, absolutely fantastic numbers, but generally we've not seen any wage growth at all. Why is this? In terms of the textbooks that I read when I was studying economics at school and college and the likes, okay, wages should be going up, shouldn't they?
Well, they should. This has been one of maybe the biggest lesson of the credit crunch era. If we had these sort of numbers and just put it in a computer model from 2007 before all this happened, then now wage growth would be 5% according to the computer, something like that.
Would it really?
So somewhere around double what we've got.
Yeah.
For those that follow the work of the Office of Budget Responsibility, this has been probably their biggest error, same with the Bank of England, that they've both continued running those sort of models and kept assuming it's going to pick up, whereas the reality, if we look around the world, is that apart from a few isolated spots, wage growth seems to go above 2% and that's it. There's been very few of the sort of main economies that have done any more than that. Look at the US, supposedly charging on, but ditto, recent numbers again, average hourly earnings 2.5%. Same as actually as it happens this morning here, total pay up 2.5% on a year ago. So it seems like that's the new normal, if you can put it like that, and it poses a lot of questions. If we were to look back again, people, economists, in fact including me, would have dreamt of this sort of scenario.
Yep.
We want it to be more like Germany where we employed more people. What we've also done is we've got the lower wage growth that Germany had then. So we've sort of got what we wanted, except when we've got it, we don't want it, as so often.
Right. Okay, so UK interest rates. What's your take on that? If you were Carney at the moment, what would you do?
Personally, I'd be looking to raise them, but not right now, because we're seeing a stronger pound. So that's doing some of the work for it. There's the sort of, that's always the issue. In fact, it's a general issue of monetary policy, but particularly true in the UK, that because of the way the pound can flare about, sometimes then you're sort of adding to a squeeze, changing interest rates. So there's spells that you sort of can't if you think it through logically, because otherwise you'd go back to the bad old days where we had real squeezes put on the economy from that sort of thing. Pound goes up, they raise interest rates, pound goes higher, and then you get more of a squeeze than you wanted.
Yep.
So you can't always do what you'd like to. But in general, yes, I'd raise them, but not right now.
Okay. And finally, car market. I'm considering doing a transaction. Lots of talk and gossip that this car market is subprime. Would you agree or disagree with that as an economist?
I think that it is. It's something I've looked into quite a bit. According to the body, FLA, it's leasing associations, the LA bit, I can't remember the F.
Right.
Round about 86% of all new car purchases come via this route now. So in essence, via their industry.
So small deposit, small repayments, give the car back at the end.
Yeah, and there are loads of issues around the thing of at what price does the car go back? Because in essence, these things are, say, typically a 3-year deal, and you buy a car for 30 grand, and then you agree to sell it back to them for 15. I'm making the numbers up here, but this sort of idea. And then what if they then, the used car market goes away, they can't then sell it? There's lots of big questions here.
Yeah.
They've changed some of the terms recently for people, but in essence, seems a good deal. But then what happens to the cars? And if you look at car sales in the UK, they slowed last year quite a bit, 5 or 6%. And I think this was the cause of that. It might seem illogical, but I think basically we've stuffed everyone full of cars. I don't mean there isn't anyone that wants one, but the number of people that wanted a car, more than normal, bought over 2015, 2016. That's why we're seeing a bit of a slowdown. And of course this spins into a lot of areas. And this is where, again, this gets quite awkward actually, because if you look at the cars we buy, mostly we don't make them. So this ironically is an issue for German and European car manufacturers. In fact, in particular, last time I looked, it was the French manufacturers that were being hit, Peugeot and so on. So this is the thing, and it affects our own production a little bit, but mostly we export what we make. So it's not like there's no impact, but it's quite a small one. It's quite a complex area, and it's the problem area, I think, in the UK. Because if
So
you look
you think you deem this is a problem, or it is
Yes.
about to be a problem?
No, I think that it is. If you look at the whole issue and throw it in with unsecured credit,
Yeah.
then that's been growing at 10% a year. You know, people were cheering recently, it only dropped to 9%. Well, if we look at other numbers for the economy, economic growth, say 2%, be reasonably optimistic, wages growth, 2%, credit growth, 10%. They don't go together, do they?
So basically, we're living on borrowed time.
To a certain extent, yeah. Same old problems.
But haven't we learned anything since the credit crunch?
I think we've learned some things, but in that particular area, and this is something where I'm a real critic of the Bank of England, when it eased policy, August 2016, after the EU leave vote, it asked for this, cutting bank rate, pushing money into the economy. Where did it think it was going to go? It's where it always goes, and that's where it's gone again. Now, it wasn't their fault that there already was an issue. You could argue past policies, but if we just stick with August 2016, obviously it didn't cause what happened before then. But there was an issue and they fed it. And that now means, of course, now, further down the road, 18 months or so down it, well, we're 18 months further into the same thing that's caused trouble in the past. And one big change, and this is something, if you look at their numbers, they've dropped out, which to mine's also an issue, not something facing us too, but for younger people, student debt.
Yep.
In the past, people had credit card debt and things like that. You could say that's an issue, but younger people facing that now, if they hit it, also have student debt. So it's not the same. It's actually worse for them, I think.
Right, we'll come back on student debt next week. Shaun, as always, thank you very much for your time.